True success in cryptocurrency comes not from speculation, but from disciplined, long-term strategy and resisting emotional impulses in volatile markets. Portfolio thinking starts with a clear thesis about an asset's role in your strategy, not buying first and rationalizing the decision afterward. ISO 20022 compliance serves as a strategic filter, distinguishing infrastructure-grade assets such as XRP from tokens that are purely speculative in nature. True diversification isn't about how many coins you own. It's about holding assets that respond differently when markets shift. Staking isn't passive income, it's a security contract that carries real risks, including slashing penalties, asset lockups, and exposure to governance decisions. Staking rewards may seem appealing, but if the token's price falls faster than your APY compounds, you're actually losing value rather than gaining it. Staking carries real risks. Your capital can be locked up for set periods, slashing penalties may wipe out your rewards, and changing regulations introduce legal uncertainty. The bank lobbying behind the CLARITY Act isn't truly about consumer safety. It's aimed at protecting their deposit monopolies by limiting retail investors' access to staking yields. Hardware wallets protect your crypto from hackers, but they offer no defense against legal actions like lawsuits, creditors, or court orders targeting your assets. Because your KYC trail ties your digital wallet directly to your personal identity, it can make you a clear and accessible target in legal disputes. A Wyoming single-member LLC shields your crypto assets by restricting creditors to a charging order rather than allowing them to seize the assets directly. Cryptocurrency should be formally contributed to a dedicated LLC rather than commingled with operating business assets to ensure legal segregation and protect your holdings. In early 2026, as retail investors sold off in fear, XRP whales quietly accumulated positions worth $710 million. Outflows from small retail investors and forced liquidations of leveraged positions reflect market panic, not a sign of fundamental weakness in crypto assets. Matthew Mellon had the right investment thesis, but ultimately lost everything because of inadequate custody arrangements and the absence of a clear succession plan. Inflows of $1.4 billion into XRP-themed ETFs signal strong institutional demand, supported by actual balance sheets, even as market volatility persists. According to on-chain data, falling exchange reserves and rising millionaire wallets indicate smart money is accumulating for the long term. ETFs provide institutional investors with transparent, diversified exposure and daily NAV alignment, setting them apart from volatile, speculative tokens. By removing banking restrictions, the Fed shifts its reputational risk, unlocking an estimated $11 trillion in institutional crypto capital. What truly gives XRP its value is its live integrations with Stellar, Hedera, Cardano, and others, proving it serves as cross-chain settlement infrastructure. Buying the dip is not gambling, it is disciplined execution, backed by a thesis, custody, legal structure, and emotional control. Here is the capstone plan. First, write your thesis, then audit staking, secure custody, track cohorts, and finally, predefine dip rules. The process begins by writing a single clear sentence that defines each asset's role: payments, store of value, yield, or growth. Audit each staked asset for lockup, unbonding, slashing, and inflation risks because high yields can blind you to hidden costs. Transfer your cryptocurrency from exchanges into self-custody and establish a Wyoming LLC to legally safeguard your assets before any dispute occurs. By tracking accumulation by large holders against outflows from small holders, you can identify signals that often mark market tops and bottoms. Define your dip buying rule in advance. When markets are calm, set clear conditions for accumulation so emotion doesn't drive your choices. The goal isn't to predict market movements, it's to create a resilient framework that endures volatility through consistent discipline, not emotional reactions. Subscribe on Substack to explore deep dives into cryptocurrency, justice, and the foundations of financial architecture.